everybody, and welcome to part 2 of chapter 7, Analyzing Common Stocks. So we left off on introducing financial ratios. So financial ratios are sort of a shorthand or a quick way to analyze financial statements. And the beauty of the financial ratios, it really does develop a relationship between the various financial statement accounts. So some of these financial ratios can bridge the gap between income statement, balance sheet, and cash flow statement. And they give a comparative analysis. So we could use these financial ratios to compare companies to other companies easily, or compare companies to previous quarters or years in their data in a way that's a lot quicker than trying to read all those financial reports. So if you had 10 companies to analyze and you put all their financial ratios in a spreadsheet, within 30 minutes, you can get a pretty good idea of where everyone stands in a comparative rational basis. If I had to look through 11 annual reports and analyze 11 different sets or 10 different sets of financial statements, it would take a lot longer and not really be as definitive. So we want to use these financial ratios, of course, to understand what is the financial condition of the company, their operating results, and compare those easily to previous historical periods in the company, last year, last quarter, and other companies in the industry. And these year-over-year comparisons, which are often denoted as an acronym YOY, are very useful in making these analysis of stock security and fundamental analysis to decide which companies are the best in the industry. So by comparing company ratios to the similar companies in the industry, we get a better idea of ranking them as far as best investment to worst investment. And understanding the company's past performance is a good way to hopefully try to forecast what their performance would most likely be in the future with a higher level of confidence. But of course, like I've always said, and everybody says, past data and past success is not a 100% predictor of future success. But it's something we have to work with. Now, the financial ratios are grouped in 5 main areas: liquidity, activity, leverage, profitability, and common stock measures. We're going to review each of these areas. So we generally would organize our financial ratios in these 5 distinct groups. Now, let's first start with the liquidity ratio. So liquidity really has to look at how liquid the company is as far as current assets, as far as cash. So we want to really understand what the company's operating expenses are, their short-term bills in relationship to their current assets. Now, the current ratio would be a measure of the company's ability to pay for their current liabilities, or it's looking at their short-term assets and their short-term liabilities, which we call current assets and current liabilities. So we simply divide current assets into current liabilities. And the higher this multiple, the more liquid the company is. So a multiple of 1 would be that their assets exactly equal their liabilities. But a reading of, say, 3 would mean that they have 3 times the amount of current assets in relationship to current liabilities, which is stronger. So basically saying that I have a credit card bill of $500, but I have $1,500 in the bank. So my current ratio is 3, which is a lot better than 1 or 2. So this is useful to know how financially strong the company is, or how likely the company would be to run out of cash. Now, a quick ratio is important because depending on the industry, some industry inventory, which is a current asset, may be very slow to turn into liquid cash. So if you're a company where your inventory was, say, unsold homes, you're a construction company and you build homes, you have an inventory of 15 homes, that may not be that liquid depending on how the real estate market is. So for some industries, you may want to look at what we call the quick ratio, where we subtract the inventory from the current assets, and we look at the remaining current assets to the current liabilities. So this might be a more realistic approach to seeing how liquid or cash stable a company is if we take away the inventory from the equation. So if it's, in some industries, if it's a recession and they're cyclical, say like auto industry, and people are not buying cars, the inventory really is something that is not as liquid. So that's why we want to take that away. Okay. Now, net working capital, I don't really see this so much as a ratio more than just a number. So we're looking at what's the total number of current assets minus current liabilities. And it's really just showing how much more current assets do we have in liabilities in total dollar terms. And we want to you have to take this number to see, is this enough liquidity to maintain or cover the short-term obligations? So one way I would look at it is, what is their short-term monthly obligations? Say like for you, it might be rent. So how many months of savings you have compared to your rent? So if your rent is $1,000 a month and you have $6,000 in the bank, then you would see that you're much more financially stable. So again, this is just looking at, you take your current assets, subtract your current liabilities, and you get an idea of what the coverage is like and how long, the bigger your net working capital, the more opportunities you have to utilize that to maintain your company's stability and even grow your company. So net working capital is really the money that you can spend after you've met your obligations in the company. Now let's move over to activity ratios. So this is more about the operation of the company. So we're going to compare things like sales, so this is expenses, and we're going to this could be sometimes also look at the efficiency ratios, how efficient the company is with its assets. And generally, the higher the ratio values, the better the firm is doing, the better it's managing its asset efficiency. So it's really about the assets the company has and how well they're being utilized to generate business. And, and then efficiency plays a big part of that. So let's look at accounts receivable turnover ratio. Your first question should be, what is accounts receivable? Okay, so business to business companies, what we call B2B, they sell to each other on credit. They don't do cash up front. Things aren't paid for in cash. So as I'm selling, maybe I'm Boeing and I'm selling planes to customers, that's all sold on accounts receivable with a promise of them paying us later. So we want to see the relationship between the sales we have, say for a year, versus the balance in accounts receivable. So what we want is a high number here. We want, if we sold $1 billion worth of planes and we had $1 billion in accounts receivable, that would be a turnover of 1, which is terrible, which means no one's paying us. But if we had, say, $8 billion worth of sales and $1 billion worth of accounts receivable, then that's a turnover of 8. So we're collecting the money much faster. And that's what we want to see. We want to see that for what we sell on credit, that money is being collected in a timely basis. So we want that accounts receivable value. Ideally, we'd like it to be a good figure here a nice figure would be 12, meaning that in an annual basis, we're collecting our money in 30 days. So a 12 would show that we collect our money on sales in 30 days. That's, most companies don't have anything that high. Usually depends on the industry. But again, here we're looking at how efficient is the company at collecting their accounts receivable, which is money basically other companies owe them based on sales. And the higher this number, the better. So the idea is, and there's a lot of different ways to collect money faster for accounts receivable, as far as putting penalties if they pay late, or giving incentives if they pay early. So, or just having a good accounts receivable team that will follow up and call people and bug people to pay them. Now, inventory turnover measure looks at how quickly a company is selling its inventory. So what we want here is, you don't want inventory to sit around too long. Think of the computer industry. Computer processing and computer features change pretty quickly. So if you don't sell your laptops or your desktops in a quick basis, new technologies, new computers are going to eclipse them. And new components, so say you built a computer, within 6 months, the price of building that same computer could drop drastically as new advanced chips come on the market. So that's a really time-sensitive inventory. So we want to look at, our sales revenue versus the inventory. So let's think of a store. Let's think of a store that sells toys. Okay, so it's just a store, a local store, and they sell toys. Now, say they sell $100,000 worth of toys a year. If their inventory turnover was 1, it would mean January 1st, they filled up their store with toys, and by December 31st, the store is completely empty without any additional restocking. That would be an inventory turn of 1. It takes a full year to sell all your inventory. That would be really inefficient and poor. What would be better is if the store completely stocked all their toys at the beginning of every month, and by the end of the month, the toys were completely sold. So that would mean that you'd have inventory turns of 12, that your inventory is being completely turned over, purchased and completely sold 12 times a year. And that's a lot more efficient. So you're tying less money up in inventory, and you're able to keep more money in cash. So now, when we say inventory, so we know what sales revenue is. It's the sales price times the amount of units we're selling. When we say inventory, you could also call it cost of goods sold. So it's the cost for us to either buy the items that we're selling or to make the items that we're selling. So sometimes you could look at the total cost of goods sold for the year divided by inventory if you wanted to, but the inventory value is basically based on the cost of goods sold. So that's why you might want to look at total cost of goods sold for the year divided by inventory, because the inventory value is the cost to make it. But I would still stick with the sales revenue divided by inventory to calculate this. I wouldn't, you could use cost of goods sold, but it really depends on how you want to define this measure. But either way, the idea is how many times a year are you fully selling out your current inventory? And then a lot of companies have improved this inventory turns as they've reduced the amount of inventory, say on a store level, on their shelves and in their back supply room. So companies have, through better transportation and better ordering systems, they've been able to not have to stock 10 toasters on the shelf, but 3 toasters were sufficient. So they have all these advanced computerized forecasting models to say, this is what our average sales of a product will be in a day. So maybe they'll keep 3 to 5 days on hand. So they have better utilization and efficiency in their inventory by managing it better. This is how push average inventory turnovers higher as companies become more efficient in utilizing their inventory. And for some companies, if you're dealing with perishable inventory like food, so a restaurant doesn't want to have a month's worth of food stocked up. They may only want to have a week's worth of time, just like your own household. You don't want to have too much extra inventory because it could spoil. And it's also space-wise. So say, for example, you eat 1 box of cereal a week. So it makes more sense to buy 4 boxes for a month and have an inventory turnover of 12 rather than buying 52 boxes at once. Where are you going to store all that cereal? And a lot of it's going to spoil or go bad or maybe be eaten by bugs or pests. So you can understand that different industries have different requirements for the holding of their inventory. So that's why all these ratios are industry specific. And some industries can hold their inventory for quite a long time with not much of a consequence. Okay, let's talk about total asset turnover. So total asset turnover is going to affect how a firm uses its assets to support sales. So again, it's sales revenues divided by total assets to see how many times the assets are generating sales, or how many times the revenues are compared to the assets. And the higher this number, again, the better. So let me give you an example. If you're a pizza restaurant and you have just one pizza oven that costs $10,000, and you can generate about $100,000 worth of revenue on this one pizza oven, but you find that you're turning people away or not able to satisfy all your orders because the pizza oven's at max capacity. And nobody wants old pizzas, so you have to kind of cook them within 10 to 20 minutes of the order. So a pizza restaurant may buy a bigger or a second oven to meet the demand. So that's going to greatly increase your assets, but should increase your revenues because now you can meet more than the demand for your product. So this is why the sales and assets kind of work in tandem. As sales are revving up, as demand is revving up, companies are going to have to build more factories or buy more inventory or get more equipment to meet their sales goals. So the trick is not to increase your assets faster than your revenues, because you don't want to buy factories that are going to be unutilized, that may be utilized in the future, but you're buying them now. No, you want to get them online just in time to meet the sales. That's much more efficient. So again, we're just looking at the efficiency of the assets. And now in some places, you might have an asset like a machine that is making a product. So the machine is able to make, an operator runs the machine 8 hours a day, and it's responsible for $1 million worth of sales. Now, instead of buying a second machine, if sales are about to double, it might be easier to have a second shift. So you're using the same asset, but generating twice the product. And then maybe add a third shift. So you run that machine 24 hours a day to generate the products for sales. That would be, you'll see your asset turnover rate go up as you're utilizing the asset 24 hours a day rather than 8 hours a day to make your product. So that would be a more efficient use rather than buying 2 additional assets. So you would run three sets of machinery for only 8 hours a day. You see how that's kind of wasteful? It's sort of like buying a second factory to run another 8 hours during the day. It'd be better to utilize your current factory and put a second shift on that factory or a third shift. And that's why the most efficient companies will run their assets 24-hour a day, and this generates higher total asset turnover. Again, you don't want to buy assets too much in advance. You want to kind of time the assets for when the revenues are needed to generate the revenue. Let's move into leverage ratios. So leverage is more financial type of ratio where we want to see amount of debt the company is utilizing to support the operations of the company. So when companies are growing, it's natural for them to take on debt to expand the business. So if you have a very hot restaurant, say for a while, Chipotle Mexican Grill is a very hot restaurant. In the area I live in, they were slow to expand. So a competitor called Carbo Fresh, is a very similar restaurant, but met the demand of people looking for a higher quality burrito or taco. And since Chipotle Mexican Grill wasn't able to expand fast enough into this market, it left the doors open for a competitor to establish themselves. So a leverage ratio, if this is measuring the debt a company is bringing on, it makes sense for companies like Chipotle Mexican Grill to borrow some money to greatly expand while they have a hot commodity, while they have a restaurant that has some buzz and interest in it. Now, we sometimes call these solvency ratios, and what we're concerned about is how much debt a company is taking on and its ability for a company to pay for that debt. So we've had other restaurants a long time ago. Before it was Boston Market, it was Boston Chicken. And this was a very hot restaurant, and it was expanding quickly, but they got a little too ahead of themselves, and they borrowed too much money and expanded too quickly, and they weren't able to service that debt. The cost of the debt was too much, and they went bankrupt. And then McDonald's bought the ashes of that company, and it turned into Boston Market. So there's an example where investors are very worried about, you may have a great business and a great business idea, but if you over borrow, it puts these certain financial risks on the company. So let's look at these financial leverage ratios. First up, we have the debt to equity ratio. So we're going to look at the long-term debt in relationship to the shareholders' equity. So what this means is the equity is the capital investors have given to the business. The money investors have given to the business. Long-term debt is the money the business has borrowed. Together, long-term debt and the shareholders' equity is what purchases most of the assets for the company. A stronger balance sheet or a stronger company will have a larger percentage in shareholders' equity. So by dividing these two, we get what percentage of the debt is, of the total company's capital is financed through debt. So we see here for this particular company, they have 60% of their of their capital is financed by debt, or 60% of their assets basically are financed by debt, which is a, depending on the industry, this may be good or may be bad, but you have to look at industry competitors to really get an idea. So, but it's helpful in assessing the stock's risks. How much exposure do they have to debt? So, of course, the lower this ratio, the better the risk. So this is one of the ratios where the smaller the ratio, the better, because it shows a smaller dependence on debt. Now, the equity multiplier is going to look at how it's going to look at the basic relationship between assets and equity and show the leverage that they utilize to buy those assets. So we want to put total assets on top and divide it by shareholders' equity. And the total assets are going to be the sum of liabilities and equity. So by getting this ratio, we figure out, is the assets financed by more debt or more equity? So the higher the multiple, the more debt that the company is utilizing. So the smaller, basically, when the equity becomes smaller percentage of the assets, the higher the multiple here. And that's what we call the equity multiplier. So a high equity multiplier would mean that the company has utilized more debt. So the higher this number, the more risky the company is, the more leverage the company has in financing its total assets. So if the total assets were equal to the total liability, you'd have a equity multiplier of 1. So our equity has only been leveraged once. Now, if they were to, say, have 100 million in equity and 200 million in assets, then that equity has been magnified by a factor of 2, which they basically have an equal amount of debt to equity. So you don't want this number to get too high. It could show that the company might be over leveraged. Now, times interest earned is looking at the ability for the firm to meet its fixed interest payments. So think of you if you had a credit card and you want to look at your earnings per month versus your interest expense per month. So if you earn $500 a month and your interest expense on your credit cards is $100, your times interest earned is 5. But it would be better if you made $1,000 a month and your interest was $100 a month. Now your times interest earned would be 10. So the higher this times interest earned ratio, the stronger your company is, the more financial strength they have to pay for their interest on their debt. Sometimes called a coverage ratio. Now, as interest rates have gotten lower, naturally interest expenses have become smaller, and this times interest earned or coverage ratio has naturally crept up higher when interest rates are lower, like they are today. As interest rates do increase, you will see these ratios change, become smaller as interest charges become higher. Okay, let's talk about profitability ratios. I think the profitability ratios are probably the most significant ratio in analyzing a security, because we're measuring the profitability at different levels of the business. So, we have there's actually, I would say it would be 3 profitability ratios. You have your operational, you have your gross, operational, and net. And they're going to measure profitability of the company at different points of the company's progress. But we're basically looking at their returns as a percentage to the company's sales. So the first one, let's look at the net profit margin, probably the most important margin. This is the bottom line. So we just take our net profits after taxes divided by our sales revenue. Sometimes it's called sales, or sales, total sales, or sales revenue, all the same thing. Now, if our profits are 139 and our sales revenues are 1,938, we have about a 7.2% net profit margin. So what's important here is that this profit margin increases over time, because investors like to see profit margins continuing to increase. Let's talk about return on assets. So return on assets, we're going to be looking at net profits after taxes divided by total assets. So this is the profits your assets generate. So if your assets are very highly utilized and they generate a lot of sales, they're going to generate more profits. So we want to see for the assets we bought, what type of return are those assets giving us? So if you had for example, if you bought a pizza oven that took 20 minutes to cook a pizza, so you can only make you can only say make, the capacity of the oven would be 20 pizza pies an hour versus a pizza oven that could cook the pizza in 10 minutes and give you 40 pizzas per hour, that if you could sell all those pizzas, you would have a higher net profit after taxes and a higher return on assets, because the pizza oven is making more pizzas faster. So we want to look at, the profits that the assets generate. And hopefully companies, as they're in business longer, they become more efficient and they utilize the assets at a higher capability, and they're able to generate more and more profits out of the similar assets. So we want to see companies maintain, the higher this percentage, the better, the better utilization they have on their assets. Now let's look at return on equity. Probably the most important measure for stockholders. Stockholders are basically the owners of the company's equity. So if you have a business and you bring money into that business and you give the business, here's $10,000 I'm giving you, this is equity in the business. So I want to see, what is the return on the equity I provide? So the company can take that equity and pair it up with some debt, but here we're just looking at the equity, the net profit after taxes in relationship to the equity. So the higher this percentage, the better. But as a company grows its equity, meaning that it makes profits, it pays down its debt, the equity naturally grows. So sometimes if this number stabilizes or declines, it's not necessarily a bad thing, because in some cases, if the company takes on too much debt, you could see a big increase in return on equity, because equity is a smaller piece of the equation. So this, generally speaking, we don't want the return on equity to fall too quickly. We'd like it to be stable or maybe growing slightly, but it's definitely a ratio that needs you to look into it some more. It's sometimes called the ROI, return on investment. So we're really just looking at the equity the company is holding in relationship to the investments to the firm. And what we want here, of course, is that the company is able to increase the profitability based on the equity that I've provided. And sometimes they'll borrow money to do that. And as long as the debt management is under control, an increasing, if you had an increasing return on equity due to well-managed debt, that's a good thing, and that's what we're kind of monitoring there. But we could break down return on assets and return on equity. And if we look at that, let's look at return on assets first. So we want to see what's driving this. So if net profit margin times total asset turnover will give us return on assets. So we could take our net profit margin and multiply by our total asset turnover ratio, and this will give us our return on assets. So this is another way of knowing, is it the profit margin changing that's increasing our return on assets, or is it the total asset turnover changing that's increasing our return on assets? So it gives us a better idea of what's causing that return on asset number to improve or deteriorate. Is it the profit margins, or is it the asset efficiency? So this is why when we take this return on assets, we can break it down to this different equation here to get a better idea what side of the company is creating the increasing return on assets. And we could do something similar for return on equity. We can take the return on assets and multiply it by the equity multiplier. So this is, again, a better understanding of return of equity. So we're going to measure the extent which, is it the financial leverage increasing the return on equity, how the debt is using the firm, or is it, so that's building that relationship, where I said the return on equity is a little bit more difficult. So let's go back to the equity multiplier. So here's the equity multiplier, just to refresh your memory. So it's the total assets divided by shareholders' equity. So we're seeing what is the relationship of assets to equity. So if we go back to the slide here, we want to know what is increasing return on equity? Is it the increasing return on assets, or is it the increasing equity multiplier? And we could break down that return on assets into net profit margin and total asset turnover. So again, we're looking in more deeply into this return on assets. So is it moving up simply because of the amount of debt is increasing, or because the firm is just managing its assets and operations better? So this is why we want to know, like, why did return on equity increase? Is it because we're taking on more debt, or is it because we're better utilizing the assets of the company? And we like the answer to be that we're utilizing the assets more efficiently and the operations more efficiently is what is the main driver of the return on equity, not that the company is just borrowing more money. Because that would mean borrowing more money does come with a risk. So what we like better is that the profits are reinvested in the firm, and the firm grows more rapidly from those profits. Okay, so let's look at the common stock ratios. So this is what investors are going to use to get a better idea of profits, dividends, and equity as relationship to the stock. So we could call these, sometimes they're called valuation ratios, market ratios. So let's look at these here. Earnings per share is probably a very big one, maybe the biggest. So this looks at, for each share of stock you have, how much earnings is related to that one share of stock. So earnings per share, we're going to get our net profit after taxes minus preferred dividends. Remember, many companies don't have preferred dividends. So if you're given a problem and there's no preferred dividends, don't freak out. It's just zero. Divided by the common shares outstanding. So for Universal, we might say it has 139 in net profits and 61 in common shares outstanding. Maybe these are in the millions, and gives us earnings per share of 2.26. And if we look at here, the price of the stock divided by the earnings gives us the PE multiple. So earnings per share is probably one of the most important ratios to look at, because it really breaks down the earnings per share of stock. Now, the price to earnings ratio, PE, is going to give us make that relationship between stock price and earnings per share. So the price of the stock's currently trading, say, at $41, and the earnings per share is $2.26. It's trading 18 times earnings. So that's pretty reasonable. So if you look at, if we look at this company for a long period of time, if it's generally trading around $18, PE of 18, you can expect that if the earnings go up to $3, then take $3, the new earnings, and you multiply it by, say, the average of 18.36 PE ratio, the stock should jump up to $55. So it's one way of predicting the future stock price if the PE multiple has been stable or increasing over time. In some cases, maybe the earnings remain the same, but the stock market generally is in the bull phase, and now it's pushed up the average PE multiples to 20. So that would say, even though with the same earnings, now with a 20 PE, that stock's going to be trading at 45. So when we do our forecasting of stock price, we want to look at we want to look at earnings per share, the price of the common stock in relationship to where the PE multiple is for the company and where we're expecting it to go for the company or the industry to help us better predict future stock prices. So PE multiple and earnings per share are probably the two most valuable ratios we're looking at as far as these common stock ratios. Now, when PE multiples have become very high, and there's some companies that have PE multiples that are 100, 200, that's a signal that they're becoming widely overvalued, and the stock prices could have a long way to fall down. Average PE multiples for the market are usually around between 15 to 20. So when you see a stock at 100, it's very, very valued or overvalued compared to the common or average PE multiple. And this is one way we can tell bubbles. When the PE multiple for the total market is, going above 25, we know that the market's becoming a little bit overvalued. So let's look at the PEG ratio. This is another good way for valuing a company. So we take the stock's PE ratio and we divide it by 3 to 5 years. You determine if you want to do 3 years or 5 years worth of growth in earnings. So we look at the growth in earnings and we want to divide it by the PE ratio. So if the PE ratio, say, is 10, and the growth in earnings is at, say, 10%, we would want to look at how that mixes together. So if a PE ratio greater than 1, the stock is fully valued. So a PE ratio equal to 1, the stock is equally valued. So now when we take that growth, so if a stock has a PE of 10 and a growth rate of 10%, we would just write 10 at the bottom, not 0.10. So 10 divided by 10 would be 1. So if the PE ratio is equal to the growth rate, so we basically multiply the growth rate by 100 to get a full number. Now, the PE ratio is 10 and the growth rate was 5%, or just simply 5, then we would have a value of 2. So that would be over 1, the stock would be fully valued or overvalued. And if it's less than 1, the stock might be undervalued. So if the PE ratio was 20 and the growth rate was 25, then we'd have a value less than 1. Now remember, when I say the growth rate, we're typically taking the growth rate percentage, maybe it's 10%, we multiply it by 100 to get a whole number to make the PEG ratio work. Because if we divide by a percentage, we're going to get a distorted number according to the scale down here. Okay, dividends per share, we're looking at our annual dividends paid divided by the number of common shares outstanding. So it's the total dividends paid for the company. Maybe it's $1 million of dividends. If they have 1 million shares, it's $1. It's $1 per share. In this case, $9 of dividends are paid over, or this could be, we'll say $9.3 million of dividends are paid over 61.8 million shares, or 15 cents per share. So it's just calculating taking the total dividends paid by the outstanding shares to get the dividend per share. Now, the payout ratio looks at the dividends per share divided by the earnings per share. So 7% of the earnings are paid out as dividends. So this is a way to target, some companies may have a target where they want to pay 30% out in dividends or earnings. So they typically want to pay 30% of their earnings as dividends. So that's why this payout ratio is important. Looking at how companies typically, the amount of money companies take from their earnings to pay out as dividends over time. Okay, book value per share. This is important to get a grounded value for a company, and we want to take the shareholders' equity and divide by the number of outstanding shares. So remember, take all your assets, sell all your assets, convert them to cash, pay off all your liabilities. The remaining money is going to be your equity. If you take that equity divided by the outstanding shares, this is the amount of money or equity you would be getting returned to you. Say a company closed down, they're going to return the equity back to shareholders. Well, they close down, sell all their assets, pay off all the liabilities, and then distribute the remaining money to each shareholder depending on how many shares you own. So that's what the book value is, really what the value of the company would be if it was just closed down today and everything was liquidated. So generally, stock prices are much higher than book values because the stock price includes not just the value of the company, but the potential for future profits and gains from running the company in the future. So that's why if the price of the stock is below the book value, there's a big problem that really needs to be looked at closely, because no company should really stock price should be below the book value. It's saying that the business has negative potential. Now, if we look at the price to book value ratio, here we're going to relate the book value of the company to the stock price and see how aggressively the stock price is being traded. So we put the stock price on top, the book value on the bottom, and we see what multiple the stock price is to the book value. So most stocks are going to have a price to book value greater than 1. So in a very strong bull market, you're going to see that maybe 4 or 5 times, the stock may be trading at 4 or 5 times the book value. But if it's too high, say it's 100 times the book value, that may indicate the stock is overvalued. So this price to book ratio is a great way to see if a stock is over or undervalued. So it's only really relatable in industry terms. We have to look at what's the industry average for price to book value, and then we can determine from that industry average, is my company in that average, close to the average, or are they a little bit higher, a little bit lower, which would indicate maybe overvalued, undervalued. Now, if a stock is overvalued, there might be a reason why this multiple is higher. If the stock may be the industry leader, the stock may have better profits, the stock may have better product in the pipeline. So it doesn't necessarily say sell whoever has the highest book value to market. It just means that those companies may be being rewarded because they're a much better company. But any extreme is bad. So this is why we want to stay away from extremes of too low or too high. So when you're interpreting these financial ratios, investors typically don't compute these numbers themselves. There are plenty of websites that will publish all of these ratios on a quarterly and annual basis. So there's a lot of ways to get these reports. There's many ways to get them free on the internet, and there's ways to pay for them. And of course, you can always calculate themselves. But these reports are going to give you vital information that's easy to read, organized in a very easy way, so you can see your company's financial ratios compared to, say, 6 other competitors or 10 other competitors, an industry average, to better evaluate this information, get an idea of how your company sits within the industry. Here's an example of a published report. I know you can't read this too well here, but this is just something where you can get information on all the key statistics, and this is the source here. You can also use Yahoo Finance and go under company statistics. In Yahoo Finance, when you get a quote, there'll be a link in Yahoo Finance where you can dive in more deeper to the company, and it'll list a number of financial ratios. There's also hoovers.com will give you information. So there's a lot of websites where you can get this. But when you're interpreting these numbers, you want to look at first historical, how the numbers have changed for the company on a year-over-year basis, but also in the industry, how it compares today to their industry competitors. So the historical trends, you want to see, for stock prices to do well and go up, you want to see historical trends where profits are growing, sales are growing over a timely basis. The company is moving forward, becoming bigger, becoming more profitable. As far as the industry ratios, you want to see that, is your company's set of financial ratios better than the average company within their industry? So that's why I develop an industry average, so you can quickly look at your company's level versus what they have in the industry. So you want to evaluate that competition. The more competitors you could have, the better, but you would want a small subset of very similar competitors. So you would want to compare, McDonald's with only 2 or 3, Burger King, 2 or 3 other very big fast food companies, maybe not to a very small fast food company that has only 15 locations. So you want to have as many similar competitors as possible when looking at the evaluation to gain information about how the company is positioned compared to their competitors, how their sales are growing. So here's an example. We could look at this company. Here's the historical data from 2016 to 2019. So we could organize the ratios from liquidity, activity, leverage, profitability, and common stock measures. And we could kind of see, through time, if you go down to the profitability measures, you see that net profit margins have been increasing, came down a little bit from 2018 to 2019. We could look at the return on assets have improved, but it looks like definitely from 2016 to 2018, most variables have been improving. When you look down the scale, earnings per share, payout ratio, price to book, and then in 2019, things take a turn, and some of these ratios start to decline. Net profits, return on assets, return on equity, but earnings per share do go up. So there's a story here, basically. Then we can look at the industry average. So are they doing better than the industry their accounts receivable returns are better than the industry. Their inventory turns are higher than the industry, better. Asset turnover is higher, better than the industry. If we look at profit margins, their profit margins are higher. The return on assets, return on equity, all better than the industry. The price to earnings are a little bit higher than the industry, but that could probably be because the stock is better than the average stock. Payout ratio is lower than the industry, and the price to book is a little bit higher. So this is telling a story of how the company competes compared to the industry averages. So we get a better idea how the company is moving forward. It looks like for 3 years they did very well. 2019, they kind of stepped back a bit. But they're still, in most categories, they're still doing better than their competitors. So this is just a very quick high-level financial ratio analysis of this furnishings company, looking at historical versus also industry. Okay, so that's the end of Chapter 7, Part 2. I hope this gives you a better insight of how financial ratios are utilized in interpreting the valuation of companies and interpreting the efficiency of companies utilizing their assets, generating profits and revenues, and overall their market measures. And I think this is really key and valuable for investors to start doing some fundamental research on companies to get to better know the position the company has within the industry and the possibilities for having a return on stock price. Thank you for your time. I'll see you next time for Chapter 8.